get talking to a couple of companies. Cholamandalam investment is in focus. The stock has surged around 70% this year so far. During its conference call, it indicated that the new business loan NPAs are below industry norms. Early vintage delinquencies have shot up, but it is not a concern right now. To discuss this and more, we have Arul Selvan, the president and the chief financial officer at the company, joining in. Hi, sir. Thanks very much for joining in. Well, if we could just start by talking about your partnership business. There was some amount of a cautious stance which is taken in on the partnership business. Can you just explain to us, the details of it? What were the gross NPAs there and why the caution?
See, the partnership business is a very small part of our business. It's around 1.5% of our total assets. We have around 10 partners whom we are working with, of which we saw some higher spurt in delinquencies with 2 of them. So we have said we will be slowing down with them, and so we have reduced our outputs with them. While with the rest of the partnerships, we have been, moving ahead with whatever is as per our plans. We will certainly have a relook at it, considering the revised RBI norms and higher, capital risk weightage, etc. So we will have a slightly higher pricing and higher this thing, but it is not due to higher losses for the rest of the partnerships, other than the 2 which I mentioned.
Okay, all right. Hi, good morning, Mr. Selvan. Nigel on this side, and always good to see you in. Well, could you tell us, the RBI had come out with these new rules just a couple of weeks or so ago. So how much of your book will fall under this unsecured category?
See, if you look at the entire consumer and consumer and small enterprises loan business, we have around 6% of the overall book under this. This is unsecured, but almost 4%, almost 4% out of the 6% is lent to businesses, and so they do not come under the consumer lending, though they are unsecured in nature. RBI regulation is to address the consumer lending, which is towards discretionary spendings, etc. So I believe that this will be exempted from this particular, higher risk weightage. The balance. 2% or the 1.5% I was talking about is what would come under the purview of the new RBI guidelines. Rest of all our portfolio are secured and also of business purposes, where none of our portfolios are towards discretionary spend.
Okay. All right. So effectively, only 2% of your entire book will be impacted by these changes in terms of RBI regulations, right, sir?
Correct.
So that wouldn't be a very big impact then.
That is not. Sorry, that's not a big impact, and considering the fact we also raised equity recently, I don't think providing incremental risk weightage of 25% on this book is not going to.
You want to quantify it, Mr. Selvan, in terms of capital adequacy? How does it impact you and the cost of funds? How much does it? How does it impact both these 2 ratios?
On the capital adequacy, because of this particular portfolio being higher risk weighted, it would impact us by around 15 to 20 basis points. So the capital adequacy will drop around 15 to 20 basis points. On the interest cost, that's a slightly different, approach, because the interest cost will go up on the bank borrowings, which are not of priority sector. If you look at our total borrowing, we have around 1 lakh crore borrowings, of which around 50% is bank borrowing. But out of the 50%, almost 25-30% is priority sector borrowing, so those will not get impacted. The balance would get, slightly higher priced as they come up for repricing. We are seeing the impact of this on the borrowing cost. Overall borrowing cost would be in the range of, again, 15 to 20 basis points on a higher risk, cost towards non-priority sector-based borrowings.
Okay. So overall impact when you borrow from banks could be, overall cost of borrowing could go up 15-20 basis points, right?
Correct.
On that 1 lakh crore, plus borrowing that you have. Okay. And this is all, you're able to pass this on. Straight
Yeah, that's what I was coming to. How to mitigate that would be a mix of various approaches. One, certainly we'll pass on some part of it. Some part of it we will negotiate with banks and try to bring a little bit down on it. And then we have the OPEX and the NCL lines to also work on to make sure that the committed 3.5% ROTA pre-tax would be delivered as much as possible.
Mr. Selvan, just 2 points. One, you said that 6% unsecured, and you said the impacted portion is 2%. Is there, are you waiting for clarity from the RBI, or this is settled? I mean, in terms of what you need to do here, increasing.
It's a mix of. May not necessarily come from RBI, but it would be an approach we would have to discuss with our auditors and also look at the industry practice and take a call. The 20 basis points increase is considering all of them as a unsecured, not necessarily the 1.5%.
Okay, just a second
it would
point.
Improve. Yeah, it would improve.
Sorry, go on, please.
It would improve, or it will be slightly lower if it is done by the rest of only the particular 1.5-2% of the book.
Okay, many financial institutions we spoke with also spoke about the one is of course the actual impact and what it does, but this is caution from the RBI. That's a good thing, because otherwise asset quality etc. has been holding very good in the system. We're perhaps at peak rates, so rates will start to go down. That's another trigger. So this caution is well taken. Would you slow down overall? I mean, your unsecured book and your plans there, could you talk to us about that? Because some have.
Yeah, see, the way it will happen is we need to price the higher risk weightage into the cost of this lending. So when we do this, automatically there will be some impact from the from the borrower side, that they may find it a little expensive. But as I said, while we would be slowing down with regard to those two partnerships where we are having a certain amount of higher stress, but with the rest we are continuing as per our plan. As of now, we'll see how it works out, because if the pricing works out unfavorably and that leads to drop, we are not going to compromise that by relaxing the underwriting norms. Our underwriting norms are set, so basis that we would be going with a slightly higher pricing.
Could you tell us who are the two partners? Could you?
Oh no, sorry, that may not be right.
And that no, so I'm just trying to understand whether this was two entity specific issues, or is it a more generalized issue? Since you're going ahead with the 8 but slowing down with the 2.
No, it is an entity specific because some of them are new startups also, so they might have become a little adventurous in what they were doing. But I think the traditional or the partnerships which have been for a longer time at continuing to be doing a good job on that.
Okay. Just quickly, sir, before we let you go, your outlook on your AUMs, best in 8 to 10 years, your asset quality improved in the previous quarter to 4.07, but it's still high as compared to, say, the previous quarters that we've seen for the company. On both these parameters, one, do you expect this kind of momentum on your AUM to continue? And two, in terms of gross NPA, what are you targeting, say, by the end of the fiscal?
See, the asset growth will moderate over the next 2 quarters. If you look at last year, the first 2 quarters were when we had not scaled up the loan against property and the home loan as well as the new businesses. And the last 2 quarters of last year was where we scaled up. So basis that, that denominator effect, you will see some amount of moderation from the 40% levels of growth or 39% levels of growth to a slightly lower growth. And as I said earlier, we should end the year with anywhere between 25 to 30% growth for the full year, year on year. With regard to the asset quality, the 0.07% you're talking about is basis the RBI new norms, and so this was not having a real comparison prior. So if the real comparison would be stage 3, which is the 90 days overdue, which we have also diverged in our investor presentation. Yes, you could see that has come down almost to pre-COVID level. And it will improve further over the next 2 quarters. As you always know, that the 3rd and 4th quarters are the one where the NPA numbers come down. So the 4.07 RBI new norms will also come below 4 in the coming 2 quarters, and the stage 3 numbers should also moderate.
All right. Mr. Selvan, very quickly, before we let you go, a couple of, directional, questions with regard to your business. Non-auto, I think, is close to around 40% now of the mix. How do you see that shaping up going ahead, and by when? If you could give us a broad outlook between auto and non-auto. And the second part is, some part of the street is expecting a rating upgrade, say in the next 12 to 18 months. Would that be fair? I think AAA is what you all are gunning for. Tell us more.
Yeah, see, if over the next 2 to 3 years, the auto part of our AUM would be in the range of around 50%, and the mortgage business would be in the range of around 30%. I would say, a bit 35% between the home loan as well as the loan against property, and the rest of the businesses, the new businesses, would comprise of around 15%, of which the unsecured should be in the range of around 8 to 10%. With regard to rating upgrade, yes, we are working on it, but it's impossible for me to say what is in the minds of the rating agencies. Yes, we would love to have a rating upgrade, but we have brought in capital and we are looking forward to it. But it's purely up to the rating agencies to decide about it.
Some brokerages are expecting it between 12 to 18 months from now. You think so?
I would be happy if I could get it earlier, but
all right. Okay. Okay, sir. Thanks a lot. On that optimistic note, we'll let you go. Always good hearing your thoughts. Wishing you well for the end of this year and looking forward to chatting with you in 2024 as well. But for the time being, we'll slip into a short break. Up